Good day, ladies and gentlemen, and welcome to the Whittier Trust Actionable Ideas conference call. At this time, all participants are in a listen-only mode. If you would like to ask a question, please enter it at any time on the bottom left-hand corner of the screen, and the presenters will answer them at the end of the presentation. I would like to now turn the call over to Teague Sanders, Whittier Trust Senior Vice President and Senior Portfolio Manager. Sir, you may begin.
Well, good morning, and thank you, everyone, for joining us in our latest Actionable Ideas webinar. Thank you for everyone on the phone, and thank you for everyone joining on the web. So, wow, 2020, huh? This year has been an eventful decade, and it's still just June. And as we're getting into this, there's a number of different things that we're looking at. We are living in a period of unprecedented events, which cause market stresses and stress in our daily lives as well. So the question becomes, as investors, how do we navigate and how do we make good decisions in these very stressful times? There's a number of different things that are kind of coming from all different angles, and we need to understand and think through how we're going to make good decisions. So we wanted to take a couple of examples of different groups and how they navigate and how they get through this, and then kind of walk through what it is that Whittier Trust that makes us different, unique, and kind of the ways we think about this. And one of the things we talk about is this idea of trading versus investing, right? And we'll get into this more in depth, but I just want to introduce the concept here and talk about the time horizon, talk about the nature of what these things do and how they add value to client portfolios. But I wanted to begin with just taking a look at current events right now and what it is that we're looking at in the world. So, obviously, look, I would be remiss if I didn't mention the bullet point missing here about civic unrest happening across our country. As an investor, I can say that I don't have all the answers, but I can say that I am bullish and optimistic about humanity. I'm confident in our democratic society that we will find answers to difficult questions and that we will be a better nation for it. Having said that, I wanted to talk about a number of things going on outside of what's topical in the news, especially here in Los Angeles, right? There is a real disconnect between the real economy and the stock market. We've seen dramatic increases in stock prices over short periods of time after dramatic falls, and yet we haven't seen the real economy recover, and we'll talk about a number of different aspects about why it is and what's going on with that. Second, I wanted to talk about what was happening very briefly with COVID-19, kind of what's happening there, and then what we're seeing from a very uplifting and positive front as it relates to potentials for both vaccines as well as antibody treatments that are in the marketplace right now. So let's talk about the real economy and the stock market. This squiggly green line on the chart shows the spread in monthly change between the University of Michigan consumer sentiment and the S&P 500. So think about this. So if the University of Michigan's consumer sentiment is at 100 and then it drops down to 80, that's a 20% decline. And what you can see is that going all the way back to 1978, this is the largest disparity that's ever happened between a change in the S&P 500 and consumer sentiment. There's a 32% delta last month between changes in the S&P 500 and changes in consumer sentiment. So what does this mean? Why is this happening? Well, consumer sentiment is really driven very much more so by the labor market. And the labor market is really taking it on the chin right here. Prior to all of this, you were seeing jobless claims at 282,000 per month, and these spiked right away to 6.9 million, and have only just now come down to 2.123 million. Still an order of magnitude beyond what we were seeing before. And this is the real change, right? This is the real economy. This is what we're going to be having to deal with as we get through this pandemic and we begin to reopen parts of society and we begin to get back to what looks like normal life again. And to that end, essentially all 50 states are back in some form of reopening. And by and large, we have not seen a dramatic increase in new cases of COVID-19. We would argue it's a very big positive. We would argue that we're seeing the efforts that we put in begin to manifest themselves, and we are beginning to see green shoots and the economy reopen again. On the vaccine front, really exciting results coming out right now. Moderna has entered phase 2 trials of their novel mRNA vaccine. So this mRNA is a new way of introducing vaccines that is different from the protein strands we used to use. And I won't get into all the science except to say that this is a new approach, and it's very exciting that they're able to get this and make this work in phase 2 already, and they're expecting to see phase 3 trials in the July timeframe. The other aspect that's really exciting is Eli Lilly is beginning a human test of antibodies, right? So once you get through the coronavirus or COVID, you develop antibodies, and Eli Lilly is developing the antibody drugs for this as well. So we're beginning to see this attack from both sides as a preventative measure in the form of vaccine, and also as a treatment and as a cure, as it were, for antibodies. And the market and market participants are really looking through and expecting this to occur. And that dichotomy is really what's driving this, right? So the market expectation, the market is forward-looking, and so they're expecting to see this work out and punch through. And that's really what's exciting and why equity markets have held up as well as they have. So again, I just wanted to remind everyone, input your questions in the box on the lower left, and we'll get to those afterwards. But I wanted to just introduce and again develop a little bit more our concept of what we talk about when we're talking about trading versus investing, right? And this has a lot to do in our minds with time horizon arbitrage, right? So the time you're holding your security or asset. It also has a lot to do with a thoughtfulness around which you look at taxes and tax implications. And when you marry those two together, you begin to get a really good construct of what it means to be an investor rather than a trader, right? Both actions can have wealth-producing effects. It's our thought that our time horizon for our clients and the way we think about the world aligns much more with investing. And so we look at this from that lens. When I talk about time horizon arbitrage, think about this as a statistic, right? Multiple studies have shown that the average hold period of very liquid, heavily traded stocks is just 22 seconds. And if you think about 22 seconds versus the construct of multi-generational wealth transfer, you begin to see where our thought process can create wealth over the long term. And so how do we do this? How do we think about the actual investing? What are the things that we try to look for, and what are the things that we try to avoid? One of the key things we look to avoid is binary outcomes. Now, 0 versus 1, all versus nothing. People right away go to, drugs and investing in new drugs and cancer treatments. And yes, that can have binary outcomes, but I would argue there's a layer of research you can do to get beyond that. I think about this more from the construct of fashion. Okay? In fashion, things are in right up until they're out, and it happens on a cliff. And so if you think about the way things can go from something to nothing immediately, that's the type of situation that we generally try to avoid. And so any retail investing that we do, we try to avoid fashion risk. We try to mitigate that as much as we possibly can. The other aspect we try to avoid is asymmetric payoff. Now, a lot of people think about this as a good thing, right? You invest a little, but with the potential for upside. What we think about this, as it relates to the asymmetry in this payoff, is the amount of risk that's being taken on over the time period that you're holding it. A great example of this is Argentina debt, issued in 2017, and it was originally trading above par. And as things devolved quickly in that country, it became very readily apparent that you could make a return-free risk by investing your money into this bond. And it was this asymmetry as the whole period moved forward that we really wanted to try to avoid. And so this is yet another situation we try to avoid as well. And finally, and this might look a little counterintuitive, we try to avoid investing based on government action. Right? Governments change over time. The motivations for different laws change over time. And so if you're investing based on what you think a government organization will do, it oftentimes is out, and you can find yourself back in one of those binary outcome situations. So in this environment, right, where we have dislocations and where we have change happening all around us, how can we actually benefit from that? Where can we look to say, I don't know what's really going on here, but I want to be able to take advantage of some of this? And so a couple things we're looking at right now. So if you're looking at investing based on an acceleration of a trend that's already being adopted in the market or the economy, that's a pretty good thing. And an easy example of that is e-commerce, cloud computing, right? So if you think about Amazon and Microsoft and their Azure platforms and their ability to make cloud computing work, that's obviously a very good thing. Obviously, e-commerce and Amazon, with the stay-at-home orders, the acceleration of e-commerce is really just benefiting Amazon a lot as well. This is a little bit counterintuitive to the next bullet point, which is destruction of capital, right? During times of distress, there will be competition removed from the marketplace. And with that competition removed are the existing players, yet stronger because of pricing power or just simply reduced competition. So destruction of capital can also be something that can come out of this. And finally, and this is fairly obvious, new technology, right? So if a new technology comes to solve a problem that was just put on the put out there because of this pandemic that will obviously have value. And things I think about this, I think Zoom is a great example of this. I think when brands become an action or a noun, they have this kind of cachet. Kleenex is a great example. FedEx, and you FedEx this to that person over there. I think Zoom is quickly becoming that for teleconferencing as well. So how does this long time horizon end up manifesting itself in actions inside of the portfolio? And what often happens when you have these long time horizons, you really end up in a period where you don't just do something, you stand there. Right? This whole need for motion or action and movement can be really counterproductive. One of the great pieces of advice my dad actually gave me was, don't confuse motion with progress. Right? This dog can sit here chasing his tail as long as he wants, but it doesn't necessarily get himself anywhere. And from an investing standpoint, how do we articulate this? It's a lot about selling just to do something, right? We try really hard not to sell great companies at a good price just to buy a bad company at a great price. Right? Price matters and valuations matter quite a bit. But over the long term, we think quality is rewarded. We think quality of management, quality of earnings, quality of communication, all of these things benefit our clients over the long term, and that's where we really want to stick. Right? We're not going to go dive into some deep value name that has a lot of hair on it just to be able to try to make a couple things work out. We're going to stick to our core knitting. So that's introduction to trading versus investing and kind of how we think about and differentiate those two actions. But I wanted to talk through, as we get into areas of more stress and yet more pandemic, spoke to a number of different groups about how they train and how they think about very stressful situations. So I interviewed a former Army Ranger captain, and we talked through what kind of survival they use and how they get through difficult situations as well. And I think there was a couple of overlaps between the way they think about difficult situations and the way we do. So they use this acronym for survival, and you can see kind of how it lines up on the left-hand side. And some of it matters a lot more to certain situations, but the first three, I think, really kind of matter a lot with the way we think about the world as well. S, size up the situation, right? And for us, this is understand what's just happened, understand what's happened in the world. U, undue haste makes waste. For us, we talk about this trading just to trade, right? If you just trade because things simply look cheap, you're going to end up in a suboptimal outcome. So having motion just to do something doesn't really work out for you. And finally, R, remember where you are. Why did you invest in this company in the first place? Is this a quality business? Was there a specific reason we got involved in this? And this will lend itself a lot to what I'll talk about in a few minutes, getting away and avoiding what's called thesis drift. So it's really interesting to kind of look through and find parallels across groups who have to make difficult decisions and try to apply them to what it is that we're doing. And so as I spoke to him further and we kind of looked through a number of things, I said to him, what actually happens during stressful situations? And how do you try to get through that? And what he said is what happens here a lot is tunnel vision. Tunnel vision is very difficult to get away from. And this happens across all stressful situations. Investing is no different. But when I think about tunnel vision, right, I think about this singular focus. You lose the ability to analyze new or contradictory information. Has something fundamentally changed in the way this company is operating or in the business model that exists that disallows you from actually analyzing that? Do you have tunnel vision in these situations? Again, this rushing to failure. If you move too quickly, right, and you sell before you've examined the fundamentals, or you get away from the tactical and strategic asset allocation decisions you've made simply because you're scared or there's panic, you're going to end up in a suboptimal outcome. It's recognizing that conditions change. History doesn't always repeat itself, but it oftentimes rhymes. Is kind of how I think about it from an investing standpoint, and that no two situations are going to be alike, but there's going to be tenets that cut across time and history that allow you to understand when a management team has lost its way, when the management team has lost its direction, and kind of be able to look through what it is that they're doing and bring it back to your original investment thesis. Striving for slow is smooth versus smooth is fast. Be methodical, right? If you think about Army Rangers and the way they're moving, it's very slow and in control. They're looking at all aspects of what's going on. We think about this too, being methodical in our approach, understanding that you have to go through steps before you get to the ultimate outcome. And for investors, and the way we talk about this is don't make a short-term price change a permanent loss, right? So things can move up and down, but you really only make it a permanent loss and make it a more difficult decision if you're panicking and selling too quickly. So from there, what are the implications as it relates to purely investing and how do we make decisions and what are the biases that we have as investors. And this comes to us from U.S. News and World Report. They put a number of years ago, and these are kind of 7 different biases that impact investment making decision process. Right, so I won't go through all of them, but you can kind of understand we're loss aversion. You don't want to, the loss is much more painful than the gain. This illusion of control. I should be able to understand this. I should be able to make things work out. But the one I want to talk about is recency bias, because recency bias, I think, really impacts and is the most impactful thing to investors during times of stress. So recency bias has to do with what's happening today will continue on forever. Right? We put too much weight on where we sit today, and we forget about things called mean reversion. We forget that things can eventually return to normal. We panic and think that things are going to stay this way forever and things are never going to change. And in fact, they tend to revert towards the mean. And so if you allow recency bias to color the way you look at the world, you can make investment decisions that put too much weight on what you think is going to be a beneficial outcome. And I'm going to put a chart up that just kind of, I think, really exemplifies in one picture what recency bias can look like from an investment making decision. And this chart shows that there's 5 potential factors in the investing marketplace, right? Artificial intelligence, energy storage, robotics, genome sequencing, blockchain technology, all very, very interesting technologies. But if you put too much weight behind what the potential impact of any of these individual things can have, you'll kind of lose sight of what the big picture is. And I would argue that the combination of any 2 of these items would not have as much impact on the world as electricity and automobiles have had. I think that there's too much weight behind an idea that's just too recent. I don't think blockchain technology is going to disrupt or be as impactful to the world as the advent of electricity. And so this is just a good example of saying and showing kind of graphically in one picture what it is that could lead to bad investment outcomes if you put too much weight behind recent trends. And in fact, if you go back to 1890 and look at some of the things that we kind of take for granted in our day-to-day lives, adoption rates take actually a lot longer for some things, and especially historically, than they do today. In fact, flushing toilets took about 100 years to come into vogue. Electricity was closer to 50. But what's interesting is that adoption rates are increasing, right? And so if you look at the purple squiggly straight up line and the green straight up line for smartphones, you can see the adoption rates of those are much quicker and still yet not as fast as television. Right? So television was almost an instantaneous adoption. Internet and smartphones have taken a little bit more time. And what I find fascinating about this graph and kind of correlates with smartphones and internet is landline usage. Right? Landline usage used to be almost ubiquitous in the United States and has now fallen off to almost 40% adoption. So a fascinating statistic to think about how quickly the world changes, where everyone had multiple phones in their house, and now there's only 40% adoption rate of landlines in the United States. So we've walked through a couple of instances of how we look at the world, how other groups look at stressful situations, how we look at trading versus investing. And I wanted to talk now about how do these come into our portfolios, and what are the implications, and what happens, and how do we make this work out? So Major Robert Rogers in 1759, who was one of the early trainers of the U.S. Army Rangers, one thing that he said in the foreword in the training manual was, tell the truth about what you see and what you do. You have to be honest with yourself. You have to be honest with why you invested in companies. And we can get wedded to these ideas, and we can get wedded to, this is a great company, I put so much time and effort into this. But if you don't analyze new information and you don't allow this to impact your decisions, you could end up owning the same company even though the entire reason you bought it has changed completely. Right? There's a very fine line between stubbornness and being wrong. And I would advocate for and push people to fight for their ideas when they're being challenged, but if you disallow new information to come into your investment decision-making process, you're going to end up in a suboptimal outcome. Again, just as a reminder, please put questions in the box as they pop up, and we'll get to those after. And the other investment application, and again, I think grammar has also evolved over the last few 100 years. Don't never take a chance you don't have to. I think what he really meant is don't ever take a chance you don't have to, the triple negative there. But what we're trying to say with this is there's not always extra points for degree of difficulty, right? I think Warren Buffett would call this staying inside your circle of competence, right? So there's a very real desire for people to step outside of what they're really good and know very well and apply the same types of thought processes from different sectors and think that they should work out, when in fact it's not necessarily the case. On top of that, you can even be inside your circle of competence, information changes, and therefore you have to reassess. And I think a great example of this is cruise lines. Right, inside of our circle of competence here at Whittier Trust, cruise lines definitely exist. We fully understood the dynamics of the cruise industry. We understood what was going on. We had a really good thesis. When things began to dislocate and it became very apparent that cruising was going to be on pause, if not on hold, for a very long time, we had to reassess what the actual thesis was and what had just changed. And what we came to realize is that it no longer became a question of, is this a good structure? Is this a good industry? This has now become a distressed debt situation. Do they have capital sufficient to make their next interest payment? Are they over-levered? This is yet a different skill set than what we came into this trying to deal with. And so recognizing that it probably left our sphere of competence, we allowed that to go on, right? We did not try to get the extra points for degree of difficulty and chase the idea down along the way. So that's how we kind of thought about a couple of ideas. Let's talk about a couple of names that do remain in the portfolio and have potentially benefited from this dislocation in the marketplace. One of these companies is a company called MongoDB. And so databases sound very boring, right? It's just storing numbers and storing letters and making sure that all the data is there and accessible when you need it. But the 3 V's of data have really, really changed all of this, right? The volume, the variety, and the velocity of data have really changed fundamentally the way databases need to work, right? In the 2-year period between 2015 and 2017, over 90% of the world's data was created. Just think about that. In a 2-year period, we essentially created more data than the entire history of humanity in the world up until that time. And we start to think about how much that really is, and just how fast it's coming at you, right? Just think about the number of tweets and emails and everything that come out every day. You begin to realize that the old way of doing databases isn't necessarily going to work. And on top of that, there's this new thing called unstructured data. In the old days, everything was stored in zeros and ones and very neat, and there were tables and there were arrays, and it was really easy to track. With tweets, with emails, with all of that, all of this data has become less structured. And how do you create a way to access and monetize that and make sure it's available for your team when you need it in an era when the velocity of it is just accelerated so much? And so MongoDB is solving for that. MongoDB was purpose-built for unstructured data. MongoDB is moving along that way, and they are taking advantage of this acceleration of a trend that was already in the economy. So they're there waiting, and now that we're all doing more tweeting and more stay-at-home, all of that data and the need for it to be monetizable, sortable, and actionable has only increased, and so has the demand for their product. Another trend that one of our companies is taking advantage of is this concept of destruction of capital. So Ollie's Bargain Outlet. If anyone on the phone has ever heard of this group, I will scratch my head a little bit. But it's a great company. Think TJ Maxx and Ross, except instead of just selling clothes and furniture, you sell everything, but you keep your costs extraordinarily low, and you have an insanely loyal customer demographic, and you're geographically focused in the Southeast. And so this business model allows for them to take advantage of the destruction of retail capital. As other businesses go out, their inventory is going to need to be sold, or as they try to avoid bankruptcy, their inventories need to be sold, and Ollie's Bargain Outlet is here to help. And so this destruction of capital actually increases inventory, reduces competition, and allows for a company who has a focus on cost and understands their business model with a very loyal customer base can actually benefit through a lot of us destroying the rest of retail, and they should be able to come out on the other side, if not as strong, then even stronger. So moving from our portfolios to kind of what do our other clients ask us about, and one of the major questions we get oftentimes is hedging. do you guys hedge? These markets are going to be coming unglued. Why don't we buy some hedges on the S&P 500? And I would argue that time is your ally in reducing volatility. Time is the ultimate hedge here, right? The reason for that is if you look out and you go back to 1926, in any given year, U.S. large cap stocks were at a loss, call it 27% of the time. But over no rolling 15-year period was there a loss. And so the longer you're willing to hang on to your stocks, the longer you're willing to hang on to your ideas, the greater the probability is that you will be at a gain. Therefore, the less volatility really matters. On top of that, options become more expensive the longer you want to hedge, right? So if I want to hedge for a couple of days or a couple of hours, that's one thing. If I want to hedge out 6 months or a year, that becomes a whole different question. And inherently, you don't know day to day if a price is going to go up or down in any given action. And so in our thought process, really the time when hedging makes the most sense is when you're matching assets and liabilities. If you have a known outcome and you can hedge to that point because you can't stomach the volatility because you have a known reduction at a known point in time, that's when you can start to make this make sense. And finally, just a timing mismatch, right? Trying to time when exactly this hedge is going to expire versus this one, it lends itself to this kind of dislocation and kind of creates an uneven hedge, as it were. So that's kind of how we think about hedging. That's kind of how we've thought about trading versus investing. This is how we kind of brought additional ideas into our decision-making process. And so from there, how do we kind of look at our takeaways? What should we be doing during these times of dislocation? So I think we've been pretty transparent and adamant on a couple of these points here, but what are the walkways, right? We would argue that speculating or panicking based on short-term market movements is something to avoid. And this is fairly obvious. I mean, everyone says, oh, don't sell. Going to cash necessitates the making of two good decisions, right? Did you make a good decision when you sold it? Did you get it right at the top? Maybe, maybe not. And then when are you going to buy back in? And if you don't need that capital over that time period, was it a better decision just to allow the volatility to exist, stomach it, and roll through it, and not have to worry about or make yet a second good decision? Again, I've talked about recency bias. Try to avoid this. Try to remember that things will change. Things will return to something that looks more like normal again in the future. I will argue that we will not be wearing masks forever, and therefore, there is this reversion to the mean that will eventually occur. And finally, value traps. I'm just going to touch on this briefly. Value traps. You can think of this when someone says to you, "Oh, it's gone down 50%. It can't go down anymore." Well, on a percentage basis, something that's gone down 50% can still go down 100%. Mathematically speaking, that's the way that works out. And so just because something has moved down doesn't inherently mean that it's become a good idea at this time. And so finally, what should we be doing? What are the things that we can be doing? We would say that this works a lot around taxes, right? So if you can make changes that used to be prohibited or the tax consequences that were just so great, take a look at that now. Right? Maybe that position, low-cost basis IBM, has come down, and you're willing to take that capital gain because it's also long-term now, and you can shift that into a Microsoft or an Apple or something with a different growth prospect or a different growth profile. So when you have things that used to be prohibited by tax consequences, is a good thing to take a look at. This is kind of constant, but we really just want to reiterate the point: focus on quality. Right? Quality will be rewarded over the long term, and so if you stick to quality during these times, and if you're looking to put capital to work, again, we would argue focusing on quality. Tax loss harvesting, I think most people are familiar with this, but during times of dislocation, if you think price changes are going to be relatively temporary, or if there's a number of different ways to sell an equity, wait 31 days and then go buy that stock back, you can harvest that loss so that in the future, you can kind of bank that and make that available for you from a tax planning perspective. Then identify relative value and dislocations, right? So be thinking about that same aspect or that same investment thesis that applied to a stock you're selling. At this market cap, is there a company that, because they're a small cap stock or a mid cap stock, has been disproportionately impacted relative to the overall environment that might be worth taking a look at? And I think that's a great way to kind of think and be market cap agnostic is a great way to think about that. And then finally, we really stress that you ensure adequate liquidity for known liabilities, right? Pulling capital out during down markets is the best way to make a temporary price change permanent. And this is where volatility can really hurt you, is if you're pulling capital out during these volatile times, that's when things can really start to turn on you. And finally, and this is a bullet point just for everyone on the phone, during times of low interest rates, do review your estate plan. Right, Whittier Trust here, we talk about holistic wealth management. Nothing happens in a vacuum, I should say. And so during low interest rates, talk to your estate plan attorneys, talk to your team, talk to your client advisor about what you can do to potentially create a series of gifts or potential new structures that will allow for intergenerational wealth transfer. And so with that, I will open up the floor to some questions. I believe Sam is on the line.
Yes, thank you, Teague. A really interesting presentation, and I think it gives our listeners a lot to think about. And while you were speaking, we had a number of great questions come in. I also encourage everyone listening to continue to submit their questions, and we'll try to get to as many as possible. To kick things off, here's a question that came in that touches on a theme mentioned by several people. What do you think about holding equities at these valuations, and are you still comfortable buying right now?
You know, that's a very good question, and it's on a lot of people's minds. I think if you look at the S&P 500 in its whole, you'll see that it looks to be at a higher valuation than average. But I would argue that if you slice just beneath the surface and you begin to look at different sectors and different aspects and individual stocks there within the S&P 500, that calculus actually changes, right? So Amazon is at a much more loftier valuation than a lot of other industrials, for example. And you can find a number of different bargains and a number of different reasons to invest in areas that don't have as lofty valuations there. The other thing to think about is that, stay focused on quality. Quality will be rewarded over the long term, and that's something that we've been focusing on here for a very long time and has benefited our client base as well. And then finally, what I would say to that is that this is where active management matters. If you're sitting purely in different funds and different ETFs, and you don't have active management to be able to take advantage of the tax loss harvesting within your investment strategies, you don't have the ability to kind of look through a number of different funds and index to find the best performers, to find the ones that have the potential to outperform or have better quality growth aspects, I think you're going to end up in a suboptimal situation. So during periods of stress, and during periods of volatility, I think is where active management shines, and I think that this time period will be no different.
Very, very good. Here's another question. When and how do I address a stock that has grown into a concentrated position?
We would argue that you should continually be looking at that, and it matters a lot, the quality and outlook of that. The ability to tax loss harvest and reduce some of that concentration, I think, is also something to be looked at often. Obviously we take a look at 10% as just kind of a milestone. Is that too concentrated? But there's a number of different ways you can plan for that, as I said, in the estate planning aspect of it. If you have a concentrated asset, is there an estate planning technique that can move a portion of that growth out of your estate in the short term, right? So for a 2-year GRAT, for example, you could move some of that growth back out of your estate. So there's a number of different ways you can look at that. But as soon as the stock does become concentrated, I would argue that you should be taking a look at that.
Also, you had a slide where you spoke about biases in making decisions. What should investors do to avoid biases when investing?
This is a really difficult topic, and we've had multiple conversations about this. It's really difficult for most people to see where their biases lie and to understand some of the things that they're not doing well. And so I would argue that this is where your advisors make a ton of difference, right? So if you have advisors who are giving you honest and good information, I think it makes a ton of difference. And we here at Whittier talk about this a lot, right? Our thought process around decision-making revolves around open debate. Right? We have layers of analysis. We have diversity of thought. We have people sitting around our investment committee meeting who are former engineers, attended medical school, former lawyers, and all of this diverse opinion comes in to allow us to look at things from multiple different angles. And so I would argue that looking through that and utilizing that platform of your good advisors will help you make better decisions and help you avoid the biases that are just really difficult for us to look in the mirror and really be able to see any given day.
Okay, here is another question. Are there sectors or areas of the market today that you think can still create value?
I would argue that while technology has grown and grown kind of disproportionately, there is still areas within technology that can work for you. I think MongoDB was one of the areas that we kind of looked at, those changes in secular growth areas. But technology should allow us to bridge the gaps that have been created by a lot of what's happened with this pandemic. And so there's a lot of accelerating trends within technology that are useful and could be invested in. I think it's going to be difficult for other sectors, right? I think if for autos in particular, that might be a difficult time. If you're looking at cruising in the near future, that might also be impacted for a while. But I do think that technology offers an interesting area to continue to look at, simply because this acceleration of trend, this acceleration of what was happening in the economy is going to continue in the future.
Thank you. Looks like we have time for one more question. This listener asked, I made the mistake of selling emotionally at the bottom. When do I get back in?
I would argue sooner rather than later, but you have to be cautious in how we do it. Jumping back in all at once is also not the best way to do it. And we talked a lot about this during our investment committee meetings, and we would argue that the way to do it is to spread out your retranching over more tranches, investing smaller portions of capital each time. Again, because each time, all the short-term market movements are more difficult, and if you put anything in on a given day, you could end up in a suboptimal space. So we would argue that sooner rather than later, and we'd argue for doing it over more tranches over a shorter time, or in shorter, smaller tranches within that as well. Well, Sam, thanks for that, and thank you for everyone for joining us. I want to say it's been a pleasure, and I want to say please reach out to your client advisor or your portfolio manager here at Whittier Trust if you have any additional questions or any additional concerns. We'd be happy to walk through any of the ideas we walked through today. Thank you.
Thank you. This does conclude today's conference. We thank you for your participation. You may disconnect your lines at this time and have a wonderful day.